Precious metals recently experienced a dramatic fall. Gold prices dropped sharply in a single day. The price of gold fell by approximately 6.3% in just one trading session. Silver prices dropped sharply in a single day. This came as a surprise to many investors. Just before the drop, prices had been climbing to new heights, creating a sense of strong upward momentum in the market. The sudden reversal caught many off guard. It showed just how quickly sentiment can shift in financial markets. The scale of the movement was significant, marking one of the most volatile days for these assets in a very long time. The numbers tell a stark story of the decline. For context, this was the largest single-day percentage drop for the yellow metal in over a decade, since 2013. Silver, often known for being more volatile than gold, experienced an even more pronounced downturn. Its price plunged by about 8.7% on the same day. This was silver's steepest single-day decline since early 2021. Such large, coordinated drops are rare and signal a major event in the market. To understand the drop, we must first look at what happened before it. In the weeks leading up to the fall, gold and silver prices had climbed relentlessly. Gold surged past its previous records, reaching an unprecedented level above $4,400 per ounce. Silver also experienced a powerful rally, with prices climbing to multi-year highs. This rapid ascent was fueled by a surge of buying activity from a wide range of participants: large institutional funds, small individual investors. The excitement was palpable as the metals seemed to set new records daily. This strong upward movement was driven by a wave of new money entering the market. A key indicator of this was the flow of funds into exchange-traded funds, or ETFs, that hold physical metal. Line chart showing the rapid increase in gold and silver ETF holdings preceding the price peak. In the week just before the sell-off, gold-backed ETFs recorded a massive inflow of $8 billion. This was the largest single-week inflow since data collection began in 2018. This shows that a very large amount of capital was chasing the rally, pushing prices higher and higher. This rapid influx of investment created a crowded trade, where many were betting on the same outcome. The silver market, in particular, experienced some unusual conditions. A squeeze developed in the London silver market. Demand for physical silver bars suddenly outstripped readily available supply. Benchmark prices in London, futures prices in New York. The dramatic price drop was not caused by a single factor. It was the result of a perfect storm of several events happening at once. The first major trigger was widespread profit-taking. Investors who had bought gold at lower prices, investors who had bought silver at lower prices, saw the record highs as a golden opportunity to sell and lock in their substantial gains. When a few large traders began to sell, it created a domino effect. Others followed suit, fearing that the peak had been reached. This wave of selling quickly gathered momentum, overwhelming a market that had run out of new buyers. Another significant catalyst was a shift in the geopolitical landscape. News reports began to circulate suggesting that trade tensions between Washington and Beijing were easing. Gold is often seen as a safe haven asset. Silver is often seen as a safe haven asset. Investors buy them during times of economic or political uncertainty. When news emerged that this major source of global risk might be diminishing, the appeal of holding these metals decreased. Investors felt more confident about taking on risk, so they sold their safe havens and moved money into other assets like stocks. The movement of the US dollar also played a crucial role. On the day of the metal's sell-off, the value of the dollar rose against other major world currencies. Gold and silver are priced in US dollars globally. When the dollar gets stronger, it makes these metals more expensive for buyers who use other currencies, euro, yen. The very speed and scale of this rally created the conditions for a sharp correction. When prices rise too far, too fast, they can become detached from their fundamental value. This is what traders call an overbought condition. Technical indicators, which are tools that analyze price charts and trading volumes, began to flash warning signs. These signals suggested that the rally was losing steam and was vulnerable to a reversal. The market had become a stretched rubber band, and it was only a matter of time before it snapped back. Finally, technical trading systems amplified the decline. Many modern trading firms use computer algorithms that are programmed to react to specific market signals. As prices began to fall, they broke through key technical support levels. These are price points where automated buying programs are often placed. Once これらのレベルを突破すると、多くのトレーディングシステムで自動売りの注文が発動しました。This automated selling, combined with the overbought signals that were already present, turned what might have been a modest pullback into a steep and rapid plunge. The machines simply did what they were told: sell. The shockwaves from this event were felt across the financial world. News channels, financial websites. Many had just finished reporting on gold reaching record highs above $4,400 per ounce. The swift reversal served as a powerful reminder of the inherent risks in commodity trading. It underscored the fact that even assets considered safe havens are not immune to sharp and sudden price swings. The market had sent a clear message: what goes up very fast can also come down just as quickly. For individuals who own physical gold and silver or funds that hold them, a day of such large losses can be unsettling. Seeing the value of your holdings drop by over 6% or 8% in a matter of hours can test anyone's nerve. The immediate emotional reaction is often fear or regret, which can lead to impulsive decisions. The most common mistake in such situations is panic selling. Selling into a falling market locks in losses and can prevent you from benefiting if and when prices recover. It is a reaction driven by fear, not by a sound, long-term strategy. The key for any investor is to remember why they bought the metals in the first place. Your course of action should depend on your original goals. If you bought gold and silver as a short-term trade, hoping to profit from a quick price increase, then a sharp drop like this represents a significant risk and may signal that the trade has gone wrong. However, if you purchased metals as a long-term store of value or as a form of financial insurance against deeper economic problems, then a single day's volatility should not change your core thesis. The long-term reasons for holding metals are not erased by short-term price action. Some seasoned investors view sharp price drops not as a crisis, but as an opportunity. A sudden sell-off can present a chance to buy a desired asset at a lower price, effectively, buying on sale. If your long-term belief in the value of gold and silver remains intact, a pullback could be a good time to add to your position at a more favorable entry point. This approach requires discipline and confidence in your investment thesis. Others may prefer to wait on the sidelines to see if prices stabilize before making any new moves. Both of these are valid, cautious responses. The most important step for any metal owner is to remain calm and informed. It is crucial to look past the dramatic headlines and understand the underlying reasons for the price movement. Check reliable sources and consider the context of the sell-off. Was it driven by a fundamental change in the long-term outlook, or was it a reaction to short-term factors like profit-taking and technical selling? By staying informed and avoiding panic, you can make a decision that aligns with your personal financial plan and your tolerance for risk, rather than one based on the market's momentary fear. Despite the dramatic one-day sell-off, many major financial institutions remain optimistic about the long-term prospects for precious metals. In fact, some prominent Wall Street firms have reiterated or even raised their price targets for gold. For example, analysts at Goldman Sachs now see gold reaching $4,900 per troy ounce by the end of next year. Similarly, JP Morgan has suggested that gold could potentially climb as high as $6,000 per ounce by 2029. These forecasts are not based on daily market noise. These bullish long-term views are grounded in fundamental economic factors that do not change overnight. Analysts point to persistent global uncertainty, the potential for low interest rates to continue, vast amounts of new money being created by central banks around the world. These conditions historically have been very supportive for gold prices. The metal does not pay interest, so it becomes more attractive when the returns on cash and bonds are low. The dramatic fall was a short-term event, but these powerful long-term drivers remain firmly in place. For now, the market has shown how quickly it can pivot. The metals meltdown was a powerful lesson in volatility. It demonstrated that even in a strong uptrend, sharp and painful corrections can and do happen. This event will likely wash out some of the speculative froth that had built up during the rapid rally. A period of consolidation, where prices trade sideways for a while, could follow as the market finds its footing. This would be a healthy development, allowing a more stable base to form before any potential future advance.